Are we in a debt crisis or are we headed for one? We are in my opinion, we are at the beginning of a very classic late big cycle debt crisis.
Is the United States heading towards a critical turning point in its financial situation? Renowned investor Ray Dalio suggests so, highlighting a concerning trend where the government's debt is growing faster than its income. In a recent interview, Dalio expressed his worry as the government borrows more money just to manage existing debt, leading to a deepening financial hole. According to Dalio, this cycle is accelerating, creating a troublesome supply-demand problem. The situation is further compounded by political dysfunction, a factor that contributes to credit rating downgrades by both Fitch and Moody's. As the government deals with increasing debts and ongoing spending, the challenges ahead seem to be mounting. Ray Dalio highlights that the challenges in the United States are not limited to domestic consequences. They also extend to foreign demand for US debt. With 40% of US debt being sold to foreigners, Dalio raises a crucial question about the country's financial health. Is the country financially strong, making more money than it spends, and holding more valuable assets than debts on its balance sheet? As the total US debt surpasses $33 trillion, Dalio emphasized the significance of managing the interest on this debt, which, despite not requiring the immediate repayment of the entire amount, is a growing concern. The rising costs of servicing this debt are creating uncertainty for Treasury bonds as demand dwindles while the supply continues to surge. Dalio sees this as a pivotal moment, signaling a potential inflection point for the nation's financial trajectory. Ray Dalio's insights hold considerable sway in financial circles due to his impressive track record as the founder of Bridgewater Associates, a leading hedge fund. Renowned for his deep understanding of economic principles, Dalio's unique investment philosophy, marked by principles like radical transparency, has resonated with investors seeking unconventional approaches. His analysis often offers a global perspective, considering interconnected economic and geopolitical factors. Dalio's proactive adaptation to changing market conditions, coupled with his public communication through interviews and educational contributions, has solidified his influence. Global central banks, historically substantial purchasers of US treasuries, are now assuming a more reserved stance. This strategic shift is aligned with the broader trend of major economies globally tightening their monetary policies in the wake of the post-pandemic era. Concurrently, there is a decline in interest from the foreign private sector towards US bonds. Economist Torsten Slok of Apollo Management has skillfully detailed this intricate subplot. His counsel is clear. Investors across diverse asset classes should engage in proper, meticulous exploration. Who constitutes the current pool of treasury buyers? What motivates their engagement? Yield sensitivity or indifference? Furthermore, an examination of the treasury auction is paramount. Ray Dalio issued a stark warning about the escalating US government debt, emphasizing that it is reaching a critical juncture that could lead to more significant challenges. During an appearance on CNBC's Squawk Box, Dalio highlighted the growing need for increased borrowing to cover deficits, foreseeing its potential to worsen the existing political and social issues in the country. Economic strength hinges on financial robustness, which in turn relies on earning more than spending, a question of a nation's income statement and balance sheet health. The United States is currently saddled in $33.7 trillion in debt. Of this total, $26.7 trillion is owed by the public, and last year alone, the government accrued a $1.7 trillion deficit to sustain its spending momentum. Compounding the issue, as the debt continues to mount and the Federal Reserve raises interest rates to curb inflation, the government incurred a substantial $659 billion in net interest costs in fiscal 2023 for debt financing. According to Dalio, this trajectory spells trouble and indicates an approaching long-term problem. The latest data reveals a noteworthy trend in foreign holdings of US government debt, amounting to $7.4 trillion, a decrease over the past year. Notably, China has significantly reduced its holdings, experiencing a substantial 17% reduction during this period. Ray Dalio underscores a critical connection between maintaining current spending levels and the escalating need to accumulate more debt. This cycle, he explains, is accelerating, pushing the nation to the point of heightening momentum, thereby creating a supply-demand issue. Building on the recent financial developments, it's crucial to consider Ray Dalio's insights from last year. At the Milken Institute Asia Summit in Singapore, Dalio underscored the significance of diversification in risk management, provided it's executed adeptly. He advised investors to be vigilant about the repercussions of significant disruptions that are reshaping the world, cautioning that the global landscape will undergo radical changes in the coming years. Furthermore, Dalio spoke of artificial intelligence, acknowledging its transformative power. However, his advice to investors was strategic. Rather than investing in companies creating AI, he recommended placing funds in companies effectively adopting and utilizing this new technology. Ray Dalio, speaking at the summit in Singapore, expressed enthusiasm for the city-state, deeming it a very special place within an exciting and evolving region. When asked about the growing trend of family offices setting up, Dalio shared key considerations for choosing a country for investment. He emphasized the importance of a country having a robust income statement and balance sheet. Additionally, an environment for civility where people collaborate for positive outcomes is crucial. Ray Dalio delves into the dynamics of the significant surge in money printing worldwide since 2020, emphasizing the transformation of what initially appeared as beneficial credit creation into a scenario where an excess of money is chasing a finite supply of goods, resulting in inflation. Dalio simplifies economics as a mathematical equation, asserting that increasing the money in circulation directly corresponds to a rise in prices by the same surplus cash in the system. He identified the collaboration of the US government's budget deficit and the Federal Reserve's expanded balance sheet and money printing as the driving forces behind a notable inflation rate, which stood at 8.3% or 12% when considering core inflation. Dalio underscores that exceeding the supply of goods and services with money printing induces inflation, irrespective of any existing supply chain bottlenecks. In this context, inflation becomes a strategy employed by governments, seen as a more palatable alternative to taxing citizens directly. People initially receive checks, only to witness the consequences later in the form of rising prices and diminishing purchasing power. Furthermore, Dalio brought attention to the impact of inflation on investments. If the S&P 500 index is down 20% year to date and inflation is up 8%, he explained that the portfolio is effectively down 28%. Speaking at the Greenwich Economic Forum, Dalio highlighted what he sees as irreconcilable differences between the world's two largest economies. He pointed to contentious issues such as Taiwan's independence, the semiconductor battle, and geopolitical tensions. Dalio acknowledged that the US-China relationship is teetering on the edge of red lines in several areas. A known enthusiast and investor in China, Dalio has played a role in Bridgewater's foray into the Chinese market, achieving robust returns amid challenging macroeconomic conditions. Looking ahead, he predicted that these contentious issues between the US and China are likely to persist and potentially intensify over the next 5 to 10 years. Against this backdrop, Dalio shared his outlook on 10-year Treasury yields, projecting them to reach 5% as inflation continues to surpass the Federal Reserve's target of 2%. He believes that prices will rise to the vicinity of 3.5%, prompting the need for interest rates to be 1.5 percentage points above inflation to balance supply and demand. In the financial markets, this outlook aligns with the recent surge in benchmark 10-year notes, reaching 4.766%, marking the highest level since 2007. Dalio's perspective on both the geopolitical landscape and the financial markets offer a comprehensive view of the challenges and opportunities unfolding in the global arena. What are your thoughts on this? Let us know in the comments below. Thank you for watching, and until next time, goodbye.